Another week down, another weekly wrap, and there's plenty for us to unpack. Not only was this the end of a week, but it was the end of the March month and ultimately the first quarter of 2022. What a start to the year we have had. I'm sure many will remember as we came into 2022, there was some momentum in December before we kickstarted into January and February, and we saw a swift correction across many of the global indices. Not many of the indexes were immune. On the ASX, on the S&P 500, the NASDAQ itself actually entered into bear market territory briefly as well. But we've actually seen a fairly solid resumption and move upwards since that date. As you can see here, on the right, we've got the S&P 500, which we can use as a proxy for the global markets. Of course, it's imperfect, but it gives us a bit of an insight into the state of it all. We have seen quite a strong bounce since we hit those lows at the end over the past couple of weeks. S&P 500 eked out again, only just by 0.1%. ASX was higher and actually outperformed it. And a lot of this outperformance has really come as a result of the strength of the commodities sector. I know that many of you are familiar with it, but we've seen many of these leading commodities names soaring higher and higher. And the underlying commodity prices have been pushing higher and higher as well, as the supply and demand dynamic is quite fascinating to watch across many of these commodities. I think looking at some of the highlights from this past week, there was a brief yield curve inversion. We will talk about what that means later on at the end of the video, so stay tuned for that one. Joe Biden invoked a Defense Production Act, which actually dates back to the 1950s. And this surrounds many of those critical minerals, from lithium to graphite, nickel, cobalt, and of course, the Australian federal budget. We're going to unpack all of these in this weekly wrap. Looking forward to it. Thank you so much for joining us. Park up, enjoy a cup of tea or coffee, whatever your drink of choice is. And also drop in a comment below as we go through. Let us know your thoughts on the March quarter and where do you think things head from here moving forward. As we always do with these weekly wraps, I thought it was worth us having a bit of that sense check and checking the pulse of the markets at this stage. When we're having a look at those high-level numbers, the fear and greed index is actually back to neutral. It wasn't long ago as the Ukrainian invasion had erupted, and of course we saw everything playing out with the inflation and interest rate narratives, that we actually entered into extreme fear territory, as low as 20 on the fear and greed index. But we're back to neutral now. We're not into the extreme greed part, but there has been some interesting spirits getting into the market over this past period in some cohorts of it, and so it's going to be fascinating to see what's next. We see the VIX is back below that key 20 level, peaked above that 35-ish level over the fear period over the past couple of months. But I think if we're having a look at the market and having a bit of a sense of it all, it looks like the market is still distrusting of this rally. There are still some uncertain narratives playing out across the board. We still haven't got a resolution in Europe. Of course, the interest rate narrative is still there. Inflation, it's not been moderated yet. And we're actually about to get our latest CPI prints over the next couple of weeks that will have, of course, the elevated energy prices and food prices contained within it. So the market isn't quite convinced. Yes, it's moving higher, but where is this momentum going to continue on to? That's what we're waiting to see. Is this a bull trap? Or however, is there legs behind this rally and have we seen the local bottoms for now? And so as we peel back some of the key pieces of news over this past week, of course, starting with the Ukrainian situation, first and foremost, the crisis there, it's still underway. Hearts going out to everyone who is affected. It's the images, the videos, it's difficult to watch, and just really, as we always hope for, a swift, safe resolution, really as soon as is possible. I think when we're looking at what's played out over this past week, we can see that Kiev has still not yet been captured. Zelensky, the Ukrainian leader, still continues to garner support and speak. He actually spoke to the Australian Parliament just recently over the past week, and he's spoken to the British Parliament, he's spoken to Congress as well, and many others. He's continuing to try and band up support through that manner. We saw that Joe Biden released 1 million US barrels a day through the Strategic Petroleum Reserves. Goes for about 6 months, so that will end up being $180 million, 180 million barrels if released in totality. And interestingly, we saw the fourth round of peace talks at Istanbul commence over the past week. There was actually some initial promising green shoot signs coming out of those. Nothing has been finalized yet, and we're waiting to see if things are actually eventuating out of it. But the initial discussion there seemed positive. So we'll have to wait to see. But of course, as mentioned, market implications, economic implications, it really fades in significance. First and foremost, it's a humanitarian crisis, and that's the real only resolution that everyone is hoping for. Everything else kind of flows out as a distant secondary. Second, following up from that is the 2020 federal budget. We know that the federal budget, it's always attracting a lot of eyes from economists, analysts, investors as well. But this one carried a little bit more important significance because we're about to enter into the midst of an upcoming election cycle with the election forecasted for May. Few key components of this federal budget. Probably the most major focus was surrounding the cost of living for Australians. We know inflation's rising. We know there are a range of contributing factors to that. So there was some immediate short to medium term relief here. The fuel excise relief, of course, was needed. Everyone's being stung at the pump at the moment, down from 44.2 cents, halved to 22 cents. This will go for 6 months. It's got a defined period, but it will provide some immediate support over the next fortnight as it is rolled out. We saw some other cost of living supports as well. Tax offset for over 10 million Australians. This will be worth $420 for those banded in the low to middle income earners. And then on the cost of living payment side, $250 direct payment immediately for around 6 million eligible Australians. So hopefully that helps in the short term. In terms of productivity initiatives as well, small to medium-sized businesses are able to access a 120% tax deduction on spend for spend in the technology and as well as skills and training sector. So hopefully that feeds into productivity. But the interesting component about this is with the election so close, the questions are, was there a lot of short-term focus from this budget? And what does this actually mean for longer-term economic growth and the economic recovery? Of course, there was still significant spends on the infrastructure side, aged care, as well as cybersecurity. So these can't be forgotten, but these were some of the headlines. If you are interested in a deeper dive and a discussion surrounding the federal budget, we did a video unpacking that story, so we'll leave links to those up above that you can check out after this one. And that then brings us to the discussion surrounding yield curve inversion. It is an often viewed indicator as a leading indicator of recession. Soon as the yield curves get close to inverting, everybody starts talking about it, and I'm sure you would have seen it discussed, whether it's in publications, videos, news articles, wherever it's been. Of course, we have seen the first Federal Reserve rate hike of the cycle since 2018. This happened in March. There's upwards of 6 rate hikes potentially forecast according to the dot plots for this year. And the question now will be, okay, where do we head from here, and what does this mean for longer term growth? We know that the Federal Reserve, along with other central banks around the world, are trying to land this soft landing where they're able to raise rates and try to curtail and keep inflation under control without inhibiting the growth and the economic recovery that has been set up through this period. Now, we've done videos on what this soft landing could mean and look like, so we'll leave links to those up above. But I guess to talk about this yield curve inversion itself, we know that yield curves traditionally slope upwards. So obviously the yields on the longer dated bond yields, say the 10-year or the 30-year, are traditionally going to be higher than, of course, the closer ones. And the curve is actually a market insight into future rates. Of course, these change over times, but it gives us a bit of an insight into what the market thinks the trajectory of interest rate rises will be over time. Yields have been rising with increased interest rate hike expectations. The 10-year is upwards of 2%, nearing that 2.5% range. But what we have seen is the 2s, 10s inverted only briefly over the past week. But when the 2s and 10s invert, this indicates potentially sharper rate rises, probably a swifter velocity than initially anticipated in the short term, so on that 2-year period. But then potentially we may need to cut interest rates over the longer term or hold interest rates, potentially as a result of growth concerns, or unfortunately, potentially as we head into recession and the central banks needing to be able to support the economy through that. So we have seen the inversion occur. We'll be watching to see if this is a persistent yield curve inversion or if it's a temporary one and we bounce back above here. As is often discussed, obviously it's been a leading indicator of recession on a number of occasions. You can see here in the visual on the right, the grey is an indicator of the periods of recession. You can see when the yield curve inversion has happened leading up to those. But it's going to be fascinating to see what the story has in store from here. And most importantly, how can these central banks, led by the Federal Reserve, but around the world, can they land this soft landing? Are they able to navigate this uncertain period, curtail inflation, but not inhibit the growth? And then, of course, we got a significant announcement from Joe Biden on the critical minerals front. We saw many of the lithium, copper, graphite, nickel, cobalt stocks, the EV battery material resources rising on Friday's session, and many people are attributing a significant factor to that, contributing to this announcement. Before we talk about Biden's critical minerals announcement, if you have enjoyed this video, don't forget to hit the like button. If you're new here, welcome. We make a daily video each and every day. So if you haven't yet, make sure you've subscribed, turn your bell notifications on. With your bell notifications on, you'll be updated every time we drop a new daily video. And we'd love to have you join the community. So what has Joe Biden done? He has recently invoked the Defense Production Act to increase domestic production surrounding critical minerals. So we know that electric vehicle demand and this decarbonisation trend continues to grow. But there's a lack of supply currently produced locally, not only in the United States, but in nations around the world. For many of these EV battery materials, like your lithiums, like your graphite anodes, like your nickels, particularly for the downstream processing, a lot of the refining, but even the upstream mining itself is done in China and in other nations. And so there is a focus on localizing supply chains, particularly with all the uncertainties we've seen play out over this past period. And we know that a lot of these minerals are critical to the economic prosperity and to the decarbonisation trend. So that's why there is an increased focus on it. There's a focus on building out these American supply chains and also helping to grow US manufacturing onshore. And this Defense Production Act has been expanded to include these critical minerals and could lead to financial as well as capability support for many of these supply chains and resources moving forward. Now, if you're looking for a deeper dive and a broader overview into what this Defense Production Act actually was and why it's so important for these resources, we'll leave links up above to that discussion. We've done a video for unpacking that in the past few days. But it is a fascinating one, and I'd love to know your thoughts on it all too. So drop in a comment below. Let us know what you think about this past week on markets and where things head from here. And as you guys know, just a standard reminder, I'm obviously just a bloke on the internet who likes talking about the markets, not a financial advisor. Nothing we discuss is financial advice. Hopefully, however, it's an interesting starting spot for you to go away and do your own research from. A big thank you for joining us. We'll catch you on a daily video very soon. For now, stay well and happy investing.